India is booming, and this is great news for real estate. Lot of inquiries of late are getting converted into real transactions. People outside of India, especially NRIs and OCIs, are taking this opportunity to sell off their old assets. The two primary reasons for selling off being: one, not able to manage the real estate properly, and two, suboptimal returns. One of my clients recently from the US sold off his old property for a sizable capital gain. He said, should we invest this money into the markets, or should we throw the money back into real estate? And third, should we buy capital gain bonds? Everyone knows that we are bullish about India as an economy and real estate as a sector. I said, why don't we also consider capital gain bonds? In this video, I exactly point out various details about capital gain bonds and also try and explain and give you certain benchmarks to measure and take a call on whether we should invest or not invest in capital gain bonds. Watch the video. The capital gain bonds are issued by quasi-government firms like IRFC, PFC, NHAI and REC. These are AAA rated firms, of course. The minimum duration of your holding period of the asset, whether it is land, building, residential or commercial, should be 2 years. Anything less than that, you are subjected to short-term capital gain, which is your income tax. These bonds are issued for a period of 5 years. They are non-transferable, non-redeemable and non-negotiable under Section 54 EC. The aggregated value that you can invest within a period of 6 months of sale is only rupees 50 lakh rupees. In the sense, any capital gain over 50 lakhs, you cannot invest in these bonds. The good point is that they carry an interest of 5%. There is no TDS, there is no wealth tax on that. But you have to pay income tax on the interest income earned. You can buy these bonds in physical or demat forms from any authorized agent, especially banks. Now let's concentrate on the most important part, which is calculation of benefit versus cost. Let us now jump into my favorite part of the discussion, the calculation. I have assumed a tax rate of 30% on the interest income. Please do have a good look on the calculation before we get into the next part of the video. You must have seen that we've invested a complete 50 lakhs on the capital gain bonds. We have immediately saved 20% of the taxes and earning a 5% pre-tax income year on year. The total savings on a 5-year basis works out to close to 46%, which is on a simple interest basis works out to 9.2% pre-tax and 7.7% post-tax. You can now come and say that I will pay the 20% tax. Let me invest the money into some other assets. You need to generate a return of 13% to beat the 9.2% benchmark set by capital gain bonds and grow the portfolio at the rate of 11.8% to beat the 7.7% post-tax benchmark set by capital gain bonds. Also note that capital gain bonds are debt in nature. For you to get double-digit return in these kind of situation or low interest market, you need to take some bit of risks. It should be equity or any other asset. So it may not really be an apple-to-apple comparison. Now that you know what you need to compare your calculations against, please take a sane call. If you have any further doubts on the calculation, please do write to me on the email mentioned in the comment section. Please do like, share, love this video as much as possible so that it would benefit people who have this doubt all the time in their mind, and I'm sure they're going to exit their real estate at some point in time or the other. Till then, all the best.